Hey buddy, welcome to this episode of Finance This Property That, powered by Strategic Finance. Today, special guest, Scott Knight from Motorlend. Funnily enough, we go to the same gym.
Yes.
And this podcast came over a gym conversation going, hey, look, we deal with a lot of self-employed clients. You do the asset, I do home. Like how do we, like, what are the similarities and stuff like that? So, and you're a nice guy. So I thought, well, shit, why don't we just get you on the podcast
100%.
and spruik your wares?
Yeah.
Thanks for coming on, man.
That's all good.
Yeah, cool. Hey, Motorlend.
Yes.
Like, obviously, motors, but like, how long you guys, tell us a little bit about your business, tell us a little about you, how many people in your business, or et cetera, let the people give the people what they want.
So Motorland's been around for 6.5 years. So I've been an asset broker for almost 12 years now in total. Over the last 6.5 years, we've moved and grown business. We do about $2 million a month in lending now. So that is all things cars, equipment, pretty much everything besides property. I employ 3 staff. So I've got 2 full-time brokers and 1 part-time marketing manager. We all work in the office. We all smash it all out. We're doing quite good. A lot of our business is the self-employed, which is obviously our common denominator between us two. About 60% of our business is actually commercial as it is. So it's quite a huge percentage.
That's massive. That's a big, because normally people just try to do everything to everyone. You guys are quite niched in what you, like what's your ideal, like what's your typical 9 out of 10 clients that you see?
Sure. So a lot of our clients tend to be obviously asset backed. They're in business. In terms of consumer lending, we're more looking at like your nuclear family. So mum and dad, 2 kids, own a property, or even renting, looking at buying their new car, whatever it might be. But when it comes to businesses, definitely more tradies is what we're seeing, what we're doing. And they're looking at purchasing their first or their 5th ute type of thing.
Yeah. Cool. What made you get into asset finance?
I liked the idea of being a solution person. So someone comes to me with a problem. So this could be a business, could be a tradie setting up his business. Day one comes to me and goes, hey, I actually need a ute. I've had a company ute. I need to hand that back. I'm setting up my own business to be a Sparky. How can I get this new ute? So it's just a case of, all right, well, my job and what I enjoy doing is finding that solution for those clients.
And they're always really grateful because that's their time where they need someone with skills, knowledge, and expertise the most.
100%.
Because it's like they've got nothing, but they want you can see the potential. They just needed someone to see the potential in them to be able to go and guide and nurture them and go, hey, this is not a forever thing. Here's your solution now, and then build that relationship. Is that how that kind of works?
Pretty much. So perfect example of a client that I've dealt with for the last, I want to say 9 years. So he started off in tier 3 consumer lending. He was an apprentice mechanic when I first did his first vehicle. After I left the brokerage firm, he continued on, followed me, and now he's got a mechanic workshop. He employs about 6 staff. He is now a tier 1 lender. He has got his personal property plus 3 other investment properties. He's got a fleet of cars for his mechanic workshop, and I've done everything inside that workshop. So his 3 cars. I've also done his hoist, his wheel alignment machines, all that type of stuff. And it's really good as a broker to see that journey of a customer going from not really good lending to being tier 1 and now, running a business that turns over $2-3 million a year.
Oh, nice. And what was the time on that journey, like from when you first met him to like how many years is that?
I've known him for about 8 or 9 years. So I've known him longer than his own son.
Yeah, right.
Which is crazy to think.
That's a bit weird.
Yeah. That certainly is a bit weird, but I'll think about it. I'm like, dude, your son's like 5. And I'm like, I've known you for longer than that. Like, it's crazy. And like, we still haven't met in person. Everything, because he's up north, like far north Queensland is where he is. And we've actually never met in person.
Man, I'm sure he'd buy you a steak and a nice beer.
Probably.
That'd be, nice steak and beer.
Yeah.
But so, he's self-employed, and that deal right from the beginning could have at least absolutely screwed him up, right? If he didn't get it done correctly at the first point, as you're building, it can, when you're scaling a business, as you would know, because you're in a business scaling, if you make the wrong move, or like in this case, choose the wrong lender or choose the wrong broker, it can slow you down and sometimes actually cost you more money. So, obviously there's people that, this is the thing I hear the most of, and I don't know enough about it, and then you know more about it than I do. they buy your cars. Like, why would a tradie or a mechanic in this thing come to someone like yourself as opposed to being lured by the number inside a dealership, right? Like, because to me, that could potentially, there's no strategy in that. They're just trying to sell you a transactional thing. There's no like thought process. So
100%.
What's the difference between what you do and what they do? I guess.
I think it does come down to that strategy piece. Like, there are examples of where we've dealt with clients 12 months ago and we've set up a game plan with a particular bank. So this client wanted to finance a new Tesla. He was in the transport industry. And I was like, well, what is your plan over the next 12 to 18 months? Are you looking at buying and financing more trucks and more trailers? He said yes. I'm like, cool. Well, if we do this deal with Westpac or BOQ, we can then do it for 12 months. We get a type of confirmable credit with them, and then they increase your limit from $250,000 to $1 million in terms of lending. So we're able to now use that. And he called me last week saying, hey, Scott, I'm ready to buy those trucks now. Do we have this facility in place with Westpac? I'm like, yes, we do. It's been over 12 months. Now he's out shopping for 2 brand new trucks. So I think that's the big piece between us and just walking into a dealership or dealing with a bank direct or working with a broker that doesn't, expressly know lender policies inside and out is what can we do today to better suit your business in the future or set you up in the future for easier lending? Yeah.
Because if you're self-employed, the income is almost limitless, right? It's depending on how much you want to work. But the thing that can hinder your income is cash flow.
100%.
And if you don't have the right cash flow, and you're making, like, how many people do you see, especially like June, right? June, they come up and go, I need to buy a vehicle. How many, because I want to save on tax? Like, I mean, do you sit there a lot and just roll your eyes? Because I do.
A lot of the time I do, because it's like you only get the benefit for the next 2 weeks for this financial year. Like, the instant tax write-off that the government has been reduced down to $20,000. So buying assets less than $20,000, there's not too many cars now. If you're buying brand new, it's pretty much impossible. But if you're looking at machinery and stuff like that, there are a few deals below 20 grand, like excavators and bobcats and stuff like that you can get to get that instant tax write-off. But there's no real benefit to rushing out and spending 100 grand at June to be able to claim it on the end of financial year. The only benefit you get is to get to claim back the GST, but you do that every quarter or every month, depending on your situation.
Yeah. So, I mean, that's just the wrong, because that has 2 big implications, right? Like, one, cash.
Yeah.
Right. You want to be able to, you got to fund that. You're not getting, I'm assuming you're not getting 100% lending. Is it 100%? Is it 100%?
Yeah, we actually typically go above 100%.
Okay. So it's a little bit different to us where it's like,
very different.
Okay. So talk us through that then.
Sure. So loan to value ratios when it comes to asset finance, lenders will have a paper valuation that an asset is worth. So let's say you go buy a brand new Land Cruiser Ute. On paper, they'll say this vehicle is worth $90,000. What all lenders will have is a percentage above that they'll go to quite comfortably without any questions being asked. So typically it's 120, 130%. So if you buy it for 90, you can typically go 18 grand above that or $27,000 above that without question. Going above that, so for example, with a Toyota Land Cruiser, if they're worth a lot more on the used market compared to brand new, a lot of accessories, modifications get done, we typically need to go to 150, 160% loan to value ratio, which is quite tough to find in terms of a lender space, but they do get done, they do happen, and LVRs, we always go above 100%.
And why would you go above 100%? Like, what's the reasoning behind that?
It's literally comes down to the paper valuation. So lenders use Red Book or Glasses Guide to be able to determine what the paper value is of the asset. Most of the time, that doesn't align with the market value of these vehicles. Land Cruisers are a major exception to that because they are always worth more than paper.
Can't even get them.
Exactly.
It's so rare. The scarcity makes them more expensive.
Exactly right. Yeah. So it's the same thing with like Lexus. There's still a 12 to 18 month wait on the GX 550s that they are building. So those Prado lookalikes. Right. But even looking at Toyota Hiluxes or Ford Rangers, they tend to be worth more in the used market than what they are brand new or what the paper value is to the lender.
Is that because of the scarcity, you reckon, or is it?
I think it's because of the modifications that some people do to these things. So they're upgrading the tray to a tradie tray. So it might have drawers and lift backs and power sockets, or like dual battery systems are very common in utes, like when people want to go camping and stuff. So there's a lot of mods, specific mods as well, that just tend to make things worth a little bit more.
Oh, okay. So when it comes to paying that loan out, they're pretty much, if they're going to 120%, they know they're going to get their money back based on what they're actually going to be doing to the thing. Because you'd get 100% for the thing and for the actual asset, and then you would just go, look, I want the extra 20% to go do these modifications, which will add this much.
Yeah.
And if it makes sense, they'll do the deal.
Yeah, 100%. And most of the time, some lenders will allow, splits disbursement. So you're buying the Toyota from Toyota and you're going to ARB for the accessories. Most of them will allow the dual payment system. That's no problems at all. Typically, we just need an invoice though.
Ah, yeah, okay. And what's sort of like the turnaround time? Like, because obviously very different from a home.
Of course, you guys are slow compared to us. Like typically, like if the deal comes, like when we speak to a client, they're upfront, honest. They get us what we need, whatever type of documents it is, in a timely manner. When we submit it, if it's what we call low doc, so low documentation, they can be done in about 10 minutes through to about 4 hours, just depending on the lender and all the checks that they need to do. If it's more full doc, it's more like a day tops to be able to assess it, because there's a lot more information that the lender needs to look at, research, compare and all that type of stuff, and make sure the feasibility is there for the deal to happen.
I'm assuming like low doc, like in our space, is basically customer declaration, accountant's letter, something along the lines of that.
We're even less than that.
Oh, God.
Which is quite scary.
So hang on, it takes less time to get a riskier deal through, but they load the rate, I'm assuming, and they load the fees and stuff.
No, weirdly enough. So actually what it all comes down to is a tick box system. So if we use one lender's example, their requirement is 2 years ABN, 1 day GST, and you must be property backed. So as long as you fit that criteria, and also no prior debts with that company, with that lender that's gone bad, so default or
pretty
bankruptcy.
Much the same for most lenders, though, isn't it?
100%. But as you would know, banks never forget about anyone.
No, they're elephants.
Absolutely. So as long as you tick box, the 5-6 tick box, it's approved. Like, it's pretty simple, pretty easy.
When you say property backed, are you using the property as security, or just they've got property?
Correct, yeah. And I think the mentality that it comes back to with these lenders is, well, if you've got a home, if you want to save your business, or your business has gone bankrupt, you would sell the home to be able to repay the debts, right?
So then why would you go full doc?
It's mainly just limits. So a lot of banks will cap you out at $150,000 or $250,000 for one transaction, or their lending exposure in total. So if a client comes to us wanting a 600 grand prime mover, well, you have to full doc that. There is no other option but to. There are certain industries, especially right now, where lenders are saying, we want to get financial documentation on these industries.
Because of the risk.
Yeah. I mean, at the moment, it's transport because of the diesel price and the diesel fluctuation. They want to make sure that people in transport and heavy diesel industries like earth moving, they're financially stable and their cash flow is coming through.
Yeah. Okay. Well, that's blown my mind.
Yeah.
Like, that's crazy. Like, such a different world, eh?
100% it is. Like, even during COVID, when developers were going bankrupt, I don't know if the banks that you work with kind of limited their risk with some developers. But
developer is the bad word.
Oh, really?
In banking. Yeah.
Oh, that's crazy.
Like they don't like it when they say you're a developer.
Yeah, okay.
Apparently you're more risky, but you are. Like, you're relying on a development to fund your deal. But
correct.
A lot of these guys actually had financials.
Yeah. Well, on our end, we actually had 2 banks that said no to developers. So if you put developer down, and they would pick up the deal and just decline it because they're like, we don't want to take part in what risk this could be. They even got into some builders. So if you're part of like a franchising system, they will say decline on those. You had to be a tradesperson, so like a sparky, a plumber, to be able to get deals done with them. They just wouldn't do builders or developers. It was crazy.
And this is the power of a broker, right?
Yeah.
You've got other options. You're not just
100%
pigeonholed into the one. Mate, can you just explain to the people, because I reckon this is one of the biggest questions. Well, I don't know the answer, so I just want to know the answer for I don't care if anyone else will know. The in-house.
Yep.
When you're buying a car, let's say going to Audi.
Yep.
Right, I'm buying a car Audi. and they've got their in-house finance versus like what's like, and they get, remember when they used to have these astronomical like rates of 1.99 or 3%? Like, what is the go? Like, what does that even mean?
Cool. This is actually a common question that we get from our clients in particular. Like, oh, look, like I can get like 199 with BYD or 1% with Audi or whatever it might be. What that deal looks like, and if you look into the fine print, there's always that little fine print at the bottom of the ad. It will generally be a deposit is required. This could be between 10 and 30% of the value of the vehicle to be put in as a deposit. Typically as well need a short term, so 12 months to 36 months. And then adding to that, also a balloon payment. So it's what we call subvention, is the technical term.
Oh.
And basically what happens is that the dealer gets paid has to pay the lender the difference between the lender's cost rate for lending that money out and the discounted rate or the advertised rate, right? All it is a method to be able to get people into the door to look at that Audi or that BYD or whatever it might be and sell them on that. And then they come to the finance department and they're like, oh, well, I want to get the 199. Okay, can you afford a 100 grand Audi, put in 30% deposit and have a 30% balloon over 3 years? The repayment's another $2,000 a month. I can't afford that. Cool. Then the other options are 5 and 7 year loan terms. The rate goes from 199 to 6, 7, 8, 9, 10%.
Right.
So it's all a marketing tactic to get people into the door, sell them on the car, and then change the finance situation later when the client figures out that they can't afford that type of finance arrangement.
And then you're already in the conversation.
Exactly, yeah. So it is it's a bit awkward for the consumer because they're left with no choice but to sign up with the dealership for the finance. They don't feel like they can step away for a moment and be like, oh, I actually want to go and compare finance options. They're kind of not given that opportunity because of the environment that they're in more than anything.
So what would you say to someone that's in that position, like this weekend, if they're listening to this podcast and they walk into a dealership and they're put in that position, what's the tactic for them? Like, well, how would you advise them if you were their broker?
Cool. I would actually say, look at the finance arrangements on the 3-year loan term subvention deal and then look at your budget. Can you actually afford that? If not, then great. Don't go into the dealership this weekend. Go speak to a broker, go speak to your bank, whatever it might be, and find out what are the repayments on a 5 or a 7 year loan term that is more within your budget, because you don't want to be overextending yourself just to try and chase the interest rate. That should never be the case.
Yeah, because I think what you just said there hits really home with me, because I don't ever tell people, because everyone does think order of operations matters, right?
Yeah.
Don't go bloody sign a contract without getting, like, that's step 4.
Yeah.
How do you go straight to step 4 without doing step 1, 2, and 3?
Yeah. 100%.
Like, it's the same bloody concept. Like, don't go and sign a contract for a car.
Yeah.
Unless you've got your shit lined up.
Yeah, 100%. And I think that's one thing that, especially consumers, is look at your budget. You're on a fixed wage every week, fortnight, however you get paid. You might get paid bonuses, whatever the case might be. But set out a strict budget. Okay, I can afford $200 a week in repayments. Speak to a broker and say, hey, I've got a budget of this. What can this allow me to borrow? They'll come back and say, yeah, on a 5-year term, you can get $36,000, $38,000. On a 7-year loan term, you can get about $45,000. You can then use that to then go look at what cars can I get for that budget. Never do it the other way around on, let's go purchase the car and deal with the finance later.
Yeah.
That's a recipe for disaster.
It's like signing a land contract and going, oh, yeah, I'll sort the finance out. But you then signed it in the wrong entity and then it's going to cost you more money. And you're like, oh, you're a business. Well, why didn't you put it in the business name?
Yeah.
You've just put it in your personal name. Then it's like a lot more time to unstick that.
100%.
I don't know what the stamp duty and can, like, the issues with that. Because if you can't just, in property, if you put your name on the contract and then go, oh, I want to just cross it out and put, you can't do that. You actually have to rescind the whole contract. Otherwise, you'll be up for double stamp duty.
Yeah, okay.
So I don't know how that works in Carland.
No,
but
it never happens in mine.
Okay,
they literally just changed
like
on
cross
the
it out.
contract.
Yeah,
pretty much.
But it's a pain in the backside. Right? Let's just get it right the first time. Wouldn't you get a quicker approval? The invoice goes out, it gets paid quicker, you get your car quicker.
Yeah, exactly.
Dealership's happy, you're happy, client's happy at the end 100%. Of the day.
Getting all your paperwork in line and in order, even like dealing with the application, making sure that your financials are all ready to go, your banking is ready to go, make sure you've got valid ID. Like it's all these little things that can cause delays with the whole process.
Like just having a checklist.
Yeah,
But
yeah.
You don't get that checklist by walking into a dealership.
Nah, definitely not.
You get that checklist from having a plan right at the beginning.
Yeah.
And going, right, okay, now I can go.
Yeah.
Because that's a bit like, we deal with a lot of self-employed clients, right? And like we were talking about how each decision actually affects the next decision.
Yeah.
So I work quite closely with, accountants, financial planners, etc. And the one thing I do ask these clients, like, are you looking to purchase any equipment or anything in the business? Like, what does this look like?
Yeah.
Because you got to bloody plan for it.
Yeah.
You got to get them with the right, and it's sequencing. Like, do you buy the equipment before we do the finance or after we do the finance, and when are we going to do it? So, how do you go about, like, let's say they've come to you for a car or an asset, whichever, commercial asset and stuff like that. Like, what's the sort of journey you take them on, because you don't know them from a borrower? So, like, what sort of questions do you ask them to understand? Like,
sure,
what's the order of operations here?
Always. So, like we deal with accountants and financial planners and all that type of stuff as well. We work very well as a team where the client will speak to the accountant sends them through. We speak to them about, all right, is this an income producing asset? Do you actually need this? Like, are you wanting to finance a motorbike in your business for God knows whatever reason? Or is it going to be like a truck that's going to be earning you, $1,500, $2,000 a day type of thing because you're able to dry hire it out, whatnot. So they're definitely conversations that we have with our clients. And in terms of sequencing, we literally step them through the whole process, explain it from the beginning. Be like, great, we'll grab some details about you. We'll go back to your accountant. We'll get a set of financials from them if we need to. And then we'll provide quotes, submit it. Pre-approval is always key. I'm sure it's always key in property finance. Pre-approval, I think, is key to make sure that you've got the funding ready to go when you are. So
you pull the trigger quicker.
Exactly. And
it's
less embarrassing, I find, like on a personal note. I think financing a truck or a car and then being like, oh, sorry, like finance has declined. It's a bit embarrassing to pull that contract out because obviously as business owners, we tend to be quite noble, I think is the right word, where we're quite proud. And I think doing pre-approval is better because you know everything from the beginning.
Like, I think everyone works a little bit. Like, I think in your case, the pre-approval would actually be really handy because you're not just buying, you don't know, what you want to buy, but you don't know like the real cost, like the post cost of, hey, this may be the price, but then you've got to actually account for this. So when we know the end result, we can work backwards, figure, okay, the minimum cost of the car needs to be this. Do you ever go, all right, the client doesn't know what they want to buy and you've got like 3 different things that they want to buy and you're like, it's like 3 different models that are like, they all have different prices. Like, dude, pick one.
Pretty much. So actually, this is actually a really good topic because obviously with property, the lender doesn't care how old the property is, right? They like, it could be a 100-year-old house or a brand new house.
They do.
They do? Okay.
Depending on the location.
All right.
Well, they do because it's like, to a point, it's like you've got to make sure a 100-year-old property doesn't have the same maintenance and structural integrity and stuff.
Okay.
So you've got to make, they don't flag it, but if it comes up on the valuation, then it's flagged and then you're like, ugh.
Okay.
But yes.
Yeah. Well, in asset finance, lenders actually care about the age of the equipment. So, for example, Westpac will only look at up to a 5-year-old asset to be able to do it with them underneath their low doc policy. Whereas other lenders, they'll go up to 25 years in a term. So you can buy a 20-year-old ute or truck or trailer, whatever it might be, and do it on a 5-year loan term. No problems at all. And I think that's one thing when talking to customers about, hey, I want to look at buying a ute. Cool, which one? Well, I've got 3. It's a brand new Hilux, a 10-year-old Land Cruiser, or a 6-year-old Mitsubishi Triton. And it's like, all right, cool. Well, depending on which one you want to borrow against, depends on which lender I go with. So we need to sort this bit out first. And I think that's crucial when lender selecting because we could say, all right, well, I can go to a lender that does all 3 of these assets. So it doesn't matter which one you pick. But the rate could be like 2, 3, 4% higher.
Difference between.
Correct. Yeah. Just by having, Scott, I want to buy a brand new Hilux. Cool. We can go to Westpac BOQ compared to like a 10-year-old Land Cruiser when the rate's going to be higher. So
because you're like the same as us, right? Policy dictates rate.
Yeah,
like all the time, right?
Yeah.
And if you don't get the policy right, then rate's almost irrelevant.
Yeah.
Like, I mean, no, I don't we call them rate choppers. I don't talk to I don't deal with rate choppers, because if you want to build a portfolio, rate is important, but not at the moment. So who's going to get you the money to build it?
Yeah.
Rate comes later.
Yeah.
When you consult. But same with you guys, right?
Yeah,
like
100%.
what do you want the thing to do?
Exactly. So like there's some people that we deal with, both consumer and commercial, where they're a bit credit impaired. It's like, all right, well, your only option is to go with this particular lender. Yes, it's going to be 13%. But it's like, you can set up your business tomorrow and make that money back pretty quickly. You're a tradie, you're a whatever it might be. So it's like, why not just wear this for 12 months, get yourself established, fix up your credit file, get some income coming in, and then we'll refinance this to a better lender later. Or we get you out of that vehicle and into a newer vehicle. Or do we employ someone in 12 months' time? So looking at the finance deal as of today based on interest rates, given your situation and your application, is useless, because it's like, who will give you the money being a brand new business?
Yeah, it's almost as if you're paying for the privilege of getting the lending.
Yeah, 100%.
And that's literally what it is, isn't it? Like it's the privilege. Do you want the lending?
Exactly.
Yeah, great. Here's based on what your current situation is, these are your options. Like,
exactly.
Do you want it or not?
Exactly. And I think some people don't understand that is sometimes today, this is all you can get. If you want it, this is what you have to take.
Yeah. And I think it also comes down to the person explaining it to them as well. It's not like, this is your only option. Like, okay, cool. Your situation is this. Based on your situation, these are the policies we needed to meet. Based on the policies we needed to meet, these are your options.
Yeah.
My recommendation is, it's literally the same conversation we have.
Pretty much. Yeah, 100% it is. And it's like, well, mate, like, what do you want to do? Like, do you want to buy this truck, this concrete pump truck? Yes, it's going to be 11%, but you can do so much more with this truck. You can make so much more money with this truck, and you've just set up your ABN last week. Yeah. So it's like, think about on the lender's perspective. Would you lend your friend $180,000 for a concrete pump truck when they only just set up their business last week? And all you're relying on is a cash flow statement to determine if this guy can afford this loan or not. They haven't even sent their first invoice yet, because they don't even have their first job yet, because they don't have their truck yet. So think of it that way as well, is like, you're basically starting from nothing and you're expecting lenders to give you
would you lend them your money?
Exactly, yeah. And some credit officers, and I'm sure you deal with it as well, and property is, some credit officers do think of, when they're approving a deal, they think about it as their money. And you've got to think about it the same way as a client is, all right, would I lend my friend this money if I was this type of applicant? Yes or no? And
if it's a no, then don't argue, just keep playing on.
Exactly.
Be grateful that you're getting something.
Yeah.
And like you said, if you're in it, if you're going into this business for the right reasons, you're going to be hungry.
Yeah.
Like no one wants to be on 11 or 13%.
No.
Mate, I like to tell you, no one wants to do that.
Exactly.
So the quicker you can work your butt off, get them off there, and then, what's the solution off the back of that? Like, what's the end game, right? So 11%, what can it potentially go back down to?
Oh, like 7, 8.
Okay. So
there's a saving.
You take a hit to save 4%, but you've actually made more than 4% because of the income that you've actually earned. You've actually made that back.
Yeah.
You can literally almost pay the loan out in a year, at some depending on what you're doing.
Yeah.
You can pay the loan out quicker. You've got that, and then do you ever refinance halfway through a term?
For commercial, we can. Quite tricky though, because the lenders think of it as, well, why are they refinancing it? Is there something wrong with the business? So they tend to delve a little bit deeper into those type of deals. For consumers, we do it quite frequently. So we help out a few mortgage brokers like yourself that we refinance car loans or novated leases to be able to better service a mortgage application.
Yeah, I've had to do that once in like the 17 years that I've had to do it, because I'm like, oh, you didn't tell me this was a...
Exactly.
They're like, oh, and this is at the very end. I'm like, oh God, no, you need that fixed.
Awkward. But we do it quite often, refinancing, because those people are like, oh, I need to free up money because my rent went up or my mortgage is going up, so I'm a little bit worried, or... Yeah, there's heaps of different reasons. Novated leases is a big thing because it's such a huge expense out of their pay that some people are starting to realize that there's no real benefit of a novated lease anymore. So we're refinancing about 2 or 3 of them a month now.
Wow.
Yeah, it's becoming quite big.
But on a commercial thing, how they said they don't like it. Surely, if you had with lender A, you went on like a really, really low doc option, right? Like it's like the bottom of the barrel one. But they also have a full doc option.
Yeah.
Surely, like if you can prove that there's been improvement, surely they'll consider.
Yeah.
Have you done any of those? Because I know with our low doc lenders, after a year, if they've had it, like if they've got the financials, you can come back to them. They'll reassess the deal based on the new financials.
No. So when it comes to asset, I can't even think of a lender that will refinance their own deal in commercial space. There's only, based off my panel of lenders, about 6 lenders, maybe 7, that will actually refinance from other lenders mid-term on a commercial loan. So it is very uncommon for commercial lenders to do it. When you get to more institutional banking, like with Westpac and BOQ, it's quite common for people to do it because you're dealing with larger amounts like $5 million to $50 million worth of lending. So, and those type of businesses, they use a broker and then we shop it between the banks even. So we'll be like, all right, well, Westpac, you've had your fund for the last 2 years. We're going to look at, shopping this $25 million worth of debt with. We'll have a look at some other lenders like BOQ, NAB, whatever it might be, and be like, all right, what can you guys do this whole transaction at? It's $25 million for all this equipment. Can we redo it? And they'll quite often shop between each other.
Yeah. Because that's important. Like that's a cash flow piece, right?
Yeah.
Like if you've done the improvement, and that's where you need someone that's going to just tell you how it is.
Yeah.
And also understanding, okay, you understand the business and what it's potentially going to achieve in 12 months, and you've already got a plan in play. Like, right, what's the roadmap basically? Then you obviously, when you're having your conversations or when they come back for more, you're like, okay, what's changed?
Yeah.
That's important. Yeah, man, what's the weirdest thing you've funded? Or like, what's the weirdest thing you've got a finance for?
There was a gas detector that I did. This was going back probably like 8 years ago. A client, I think I did like a Ford F-150 for him and something else, and then he randomly rang me and he said, oh, I need to finance a gas detector. I'm like, what are you going to use that for? And he was in plumbing and civil down in New South Wales. I think it was like southern New South Wales somewhere. And I was like, what does it do? And he goes, literally, it's a device, handheld device. It was about $25,000 for this device, and it's handheld. It's got a big, massive, I'll call it an antenna, obviously a detector of some sort, and it literally pulls air through it to then work out what gases are in it and percentage. So it'd be like methane or carbon dioxide, whatever it might be, right? So he can then better assess on what type of PPE is required to be able to go into these job sites. Yeah, and I was like, how often are you doing this? And he goes, I actually have to rent one every single week. So he's like, by the time I rent it, I can just buy my own, finance it, and it's equivalent to 1 week's payment for a monthly payment. So he's saving money by buying it and financing it himself.
Oh, then you've got the depreciation, then you've got the all the add backs.
Yeah.
But also the cash flow.
Yeah. 100%.
He's got his cash flow back.
Yeah, exactly.
So he's got 3 times, or if 1 week's hiring.
3 weeks.
Yeah, he's saving 3 weeks.
Yeah.
You can go deploy that into other areas in the business.
Exactly. And this device that he was renting was about $500 a week, but at the end of the day, it's $1,500 a month back in his business that he could put into something else like marketing or another device.
A new F-150.
Exactly, another F-150. Yeah.
No, far out. What's your most common request? Like, what's the car, like, or what's the asset that you're doing the most of right now?
Oh, it's probably no big shock. It's the Hilux. Like, they're the number 1 selling ute in Australia, so they tend to be the biggest.
What's the wait time?
Oh, which is interesting. Like some dealers are like 2 to 3 months, some are 6 months. But when it comes to new dealers getting stock, it comes down to their relationship with their manufacturer. Client came to me wanting a new Hilux. I was like, cool, I've got a vehicle broker. He said it can take up to 6 months to get this thing in. It was just a Toyota Hilux SR5. He wanted a cab chassis because he was going to put his own tradie spec tray on the back. 6 months was too long because he was hiring a new staff member. In 3 weeks' time, they were onboarding. So he needed to free up his personal ute to be able to hand to that new employee. He gets his own. He gets his new ute. I found one in stock down on the Gold Coast, ready to rock and roll. So I think it comes down to contacts and the dealership themselves on, when is something available. And the thing is, like, the client didn't have to compromise on color. He wanted dark gray. He got dark gray. Whereas some of these other dealerships are like, yeah, it'll be 3 months for a dark grey. So I think it just comes down to the relationship that these dealers have with the manufacturer.
It's also, you know where to look.
Yeah, I mean, I did 3 Google searches. So 3 dealerships that I'm like, these type of dealers tend to have stock. And then I literally just, the third one got lucky, rang the dealership and said, hey, mate, I need a good price on this. I've got a client ready to go, wants to pick it up ASAP. And I think he's due to pick it up in about 3 days' time.
Oh, so it's really recent.
Yeah. That's a very recent deal.
Yeah, wow. The controversial last question.
Yeah.
What is your take on EVs? Like, where are they going? What's
Sure.
happening with the financing and
Cool.
stuff like that?
So financing is good. Lenders are on board with it, of course, because their whole business model is to lend out money. So they're all fine. Some of the lenders do offer discounts on interest rates. So some are 0.5%, some are 1% cheaper. The reason for this is they get their money for that particular lending from the Green Energy Fund. So that's the Australian government initiative. So they're able to borrow it cheaper, therefore lend it out cheaper. In terms of where I see EVs, obviously we're seeing a lot of them coming into the market. I think the future of cars in Australia is going to be a mix between petrol, diesel, and EV and hybrid. I don't think it's going to be fully EV, fully hybrid or anything like that. I think it's going to be quite an even mix. And you can see this with all the manufacturers. They're changing it up to go from petrol to hybrid, like the new Prado and the new 300 series. They're all mild hybrids. So I think that's going to be the future of cars in Australia. EVs, I think there's still always going to be a marketplace in there. Like, they're great for people that live in the city and that drive like 10 kilometers a day to and from the office type of thing. May not be situated or best for people that live in the country that are having to drive 30 kilometers just to get to work, because then they're going to have to do maybe, 4 days and then charge it type of thing. So maybe a convenience factor for out there.
Yeah, I think the infrastructure still needs to be built out a little more. I've got an EV. I love it.
Same. I've got a BMW i4. I've recently installed a charger in the office. So it's a 22 kilowatt charger, I think is the one that we got. Basically, I'm in the office 9-10 hours a day. So it's like, well, while I'm there, just plug it in. It doesn't even take 10 hours to charge. I think at the moment it's taking from about 20% to 80 is like 3.5 hours. And I only do that like once a week. Maybe not even that. I think I might be able to get a bit over a week worth of charge given the kilometers that I do. So one of my staff members, she's got an EV as well, and she just plugs it in when she's in the office and charges it. So free power for her, unfortunately. So
yeah. Oh, well, that's good. At least that you're incentivizing your staff as well. Like coming to the office, you got free power, free charging. No, that's interesting. Yeah, because the EV is like there's so many in the market. I think one of the biggest fears, like I think I was telling you, but I've got mine on a 5-year lease, is that balloon payment, right?
Yeah.
Like, making sure you're not overcapitalized.
100%.
On the, I think you were saying as long as you're within like 30, 35, you should be okay.
Yeah. So I think with any vehicle, there's a few outliers, but if you can do a 5-year loan term and you want a balloon payment to keep repayments low, doing 25 to 30% is perfect because that vehicle is going to be worth more than 30% of its value in 5 years' time. Doing 25% gives you a little bit more comfort. The outliers are like your Rangers, your Hiluxes, your Land Cruisers, where they're worth 40 or 50% value in 5 years' time. So you can do a slightly higher balloon payment with those. When it comes to EVs, hybrids, anything else, stick to the 25, 30%. And you're going to be pretty safe in 5 years. And a pro tip for it, if you're looking at buying let's say a brand new Tesla, you want to look at what would the car be worth in 5 years' time. Look at a 2021 Model 3 Tesla, whatever you're buying.
And you go back 5 years, yeah.
Exactly. And look at what it's selling for on the market. Take off a few $1,000s off it, just in case the market fluctuates between now and 5 years' time. But at least it gives you some historical information on what this car could be worth in 5 years' time based on today's value on a 5-year-old Tesla.
Yep.
Perfect way to do it.
And then don't even worry about CPI or anything like that.
No.
Just don't inflation adjust it. Just go, right, 2021, it's 2026. That's basically what the average is.
Yep.
We're pretty...
Take off a few thousand and you're going to be fine.
Yeah. I might do that with mine.
Yeah.
But I don't think the Model Y hasn't been out for 5 years, is it?
I wouldn't know that off the top of my head. No, it'd be pretty close.
Pretty close. You get a good gauge, eh?
Yeah, I'm pretty sure it was pre-COVID that thing came out. So it should be fine. I mean, the Model Y and the Model S, I think, are the ones that they don't make anymore. So it's a bit hard to gauge those valuations.
No, they still make the Model Y.
Not in Australia.
No.
What am I thinking of? Model X and S.
Yeah,
The big SUV and the big
Yeah.
sedan.
Yeah,
They don't
yeah.
make those anymore.
No, so they still do the Y. The new Ys look quite nice.
Oh,
I quite like them.
Yeah,
They're nice.
Yeah.
Anyway, and they still make the Model 3.
Yes.
So
yeah.
did you know that SEXY?
Sexy.
Yeah. Anyway, it was really weird. Like, oh, that's a little trivia question. Anyway, man, hey, thanks for coming on.
That's so good.
It's really, really appreciate it. It gives a good insight into, if you are a business owner, it's all about getting yourself in front of the right people, having the right people on your team that they're really good at what they do. I mean, I have no idea about asset finance. I don't do it. It'd just be too much noise in my head to do it. But having someone like yourself that you can just go, hey, just go have a chat.
Yeah.
There's no, it's so much easier. But also, if we're having a chat about like anyone that I refer to, I don't ask for payments or anything like that, but I have a really good understanding of what the client's going to do. I normally would email that person, do the introduction, like, here's the information. At least you're getting, you're not walking into it blind when you're having a conversation. But mate, how do we get a hold of you? Like, what's your socials and website? And
so website's obviously motorlend.com.au. So it's motorlend.com.au. Social media, search Motorlend.
Yep. Easy.
We've pretty much got a pretty easy tag to find us. We're quite active on it. We're posting every day, I think, on Instagram and TikTok and the
your
likes.
marketing lady.
Yeah. My marketing manager, she does a wonderful job getting all that done and bossing me around on what content to do, what to say, where to be, which is good. But yeah, so reach out to us. We obviously specialize in consumer and commercial finance. We just don't do property. That's the only thing that we don't do.
I think that's good because you stick in your lane, right?
Yeah.
You stick to what you're good at. Don't spend your energy on stuff that you're not.
No, exactly. Yeah. And being 12 years in the industry, I've got 2 full-time brokers. One's been with me for about 18 months, the other one about 3 years in total. They've got a pretty good grasp on what needs to happen on particular deals, different structures, different corporate structures. We're pretty well versed.
Awesome. As always, everyone, the information on this podcast is very general in nature, doesn't take into consideration your personal circumstances. You want to talk asset or commercial type asset finance, Scott's your guy. You know where to find him. Property, come to see us. Very, very simple. It's all about having that roadmap and understanding when to borrow and at what point, not signing a contract and then figuring out how much you can borrow. Very easy to find on the socials at stratega.finance on Instagram. And I'm on LinkedIn, but you can also jump on the website, www.strategafinance.com.au. All the podcasts are there, blogs, a little bit about what we do, who we are, etc. And watch out for some new videos that are coming up from client testimonials, and the team page is coming up soon. But thanks for listening. Until next time, see you all on the next episode.